Over 61% of Americans do not understand basic tax concepts. According to a 2024 Tax Foundation survey, most people have no idea how deductions actually work. This lack of knowledge costs the average American nearly $1,000 every single year. That's money you could save, money you could invest, money that's yours. Think about that. $1,000 gone. Not because you don't work hard enough, not because you don't deserve it, simply because no one taught you how the tax system actually works. But today, that changes. I'm going to show you everything about tax deductions, step by step, no confusing words, no complicated math. By the end of this video, you will understand tax deductions better than 90% of Americans. You will know exactly what to do at tax time. You will keep more of your hard-earned money. And I promise you, I'll reveal some deductions later that most people never claim. Stay until the end. So what is a tax deduction? It's simple. A tax deduction reduces the amount of your income that gets taxed. Think of it like this. Imagine you earned $50,000 this year. With a $15,000 deduction, the government only taxes you on $35,000. The government pretends you made less money. The IRS states that deductions lower your taxable income, which then reduces your final tax bill. This is the key concept. Deductions do not reduce your tax bill directly. They reduce the income that gets taxed. The result? You pay less in taxes. Sometimes, much less. Here's the beautiful part. Everyone qualifies for at least one type of deduction, whether you rent or own a home, whether you're single or married, whether you work for someone or work for yourself. The tax system has something for you, and I'll show you exactly how to find it. There are two main types of deductions you need to know: the standard deduction and itemized deductions. You get to choose which one to use. According to the Tax Policy Center, about 91% of taxpayers now use the standard deduction. But that doesn't mean it's always the best choice. The standard deduction is a fixed amount. The government says, okay, we'll subtract this much from your income automatically. For 2024, single filers get $14,600 and married couples get $29,200. Easy, no paperwork, no receipts, just boom, instant deduction. But here's where it gets interesting. Itemized deductions let you list out specific expenses, things like the interest you pay on your house loan, or the money you give to your church, or even some medical bills. If those add up to more than the standard deduction, you save more money. Later, I'll show you exactly how to know which one to pick. Let's start with the easy one, the standard deduction. According to Clemson University research, this is a dollar-for-dollar reduction in taxable income. So if you make $40,000 and take the standard deduction of $14,600, you only pay taxes on $25,400. You don't need to save receipts for the standard deduction. You don't need to track expenses. You don't need to prove anything. The government knows you have basic living costs, so they just give you this deduction automatically. It's like free money, kind of. The amount changes based on your filing status. Single? $14,600 for 2024. Married filing together? $29,200. Head of household? $21,900. And if you're 65 or older or blind, you get extra. The IRS adds $1,950 extra for single seniors. This is important to remember. Did you know the standard deduction almost doubled in 2018? The Tax Cuts and Jobs Act significantly increased it. Before 2018, only about 70% of people used the standard deduction. After, the Tax Policy Center reports it jumped to 91%. Why did this matter? Because more people could now benefit from taking the simple option. Instead of spending hours tracking every receipt from your charity donations and medical visits, you could just take one big deduction and save more money. The change helped millions of families. But this also means some people who should itemize don't. They assume the standard deduction is always better. And sometimes, it's not. Stick with me, because later I'll teach you the exact formula to know which one saves you more money. Now let's talk about itemized deductions. This is where things get powerful. According to the Tax Policy Center, the most common itemized deductions are state and local taxes, mortgage interest, charitable contributions, and medical expenses. When you itemize, you list out every qualifying expense. You write down the $12,000 you paid in interest on your home loan this year. You add the $3,000 you donated to the food bank. You include the $8,000 you spent on surgery that insurance didn't cover. Then you add it all up. If your total is more than the standard deduction, you itemize, and you save more money. According to Smart Asset Research, the average itemized deduction in Wyoming is over $120,000. Imagine reducing your taxable income by that much. We'll break down each category soon. Who should itemize their deductions? According to IRS data, high-income taxpayers are much more likely to itemize. The Tax Policy Center found that nearly two-thirds of people earning over $500,000 itemize, compared to only 10% of those earning $50,000 to $100,000. But it's not just about income. You might benefit from itemizing if you bought an expensive house with a big mortgage and paid lots of interest this year, or you had a medical emergency and spent thousands on hospital bills, or you gave a lot of money to charity last year. Here's my advice. Calculate both. Add up your potential itemized deductions. Compare that number to your standard deduction. Whichever is bigger, that's what you use. Tax software does this automatically, but knowing how it works, that's what separates smart taxpayers from everyone else. The first major itemized deduction is SALT. No, not the white stuff in your kitchen. SALT stands for state and local taxes. This includes your state income taxes, local taxes, and property taxes. The Tax Policy Center notes this makes up about 19% of all itemized deductions. But there's a limit. The Tax Cuts and Jobs Act capped SALT deductions at $10,000. So even if you paid $25,000 in state and local taxes, you can only deduct $10,000. This hit people in high-tax states like California and New York hard. Good news, though. The cap increased to $40,000 for 2025 through 2029 under new legislation. This could make itemizing more attractive for many people. If you live in a state with high taxes, this is something to watch closely. One of the biggest itemized deductions is mortgage interest. If you own a home with a loan, you can deduct the interest you pay. According to the Tax Policy Center, mortgage and other interest makes up about 26% of all itemized deductions. Here's how it works. Let's say you pay $1,500 per month on your house loan. Part of that goes to the loan itself. Part goes to interest. The interest part? Deductible. Over a year, that could be $15,000 or more. Your bank sends you a Form 1098 showing exactly how much interest you paid. There is a limit. You can only deduct interest on the first $750,000 of mortgage debt. This limit was reduced from $1 million under the Tax Cuts and Jobs Act, but for most homeowners, this won't matter. The deduction is still incredibly valuable. Do you donate to charity? Then you might get a tax break. Charitable contributions make up about 33% of all itemized deductions. That's the biggest category. So when you give $500 to your local animal shelter, or donate clothes to the Goodwill, or support your church, you can deduct it. You need proof, though. Keep the receipt from when you dropped off those old clothes at the donation center. Save the email confirmation from when you donated online to the Disaster Relief Fund. For donations over $250, you need a written statement from the charity. Here's something most people don't know. You can also deduct 14 cents per mile when you drive for charity. So if you drove your car 100 miles to help deliver meals to elderly people in your community, that's $14 back. These small amounts add up. Medical bills can be crushing, but there is some relief. You can deduct medical expenses that exceed 7.5% of your adjusted gross income. The key word is exceed. If your income is $50,000 and you spent $10,000 on medical bills, you can deduct the amount over $3,750, which is $6,250. What counts as medical expenses? A lot. the surgery you needed that insurance only partly covered, the dental work that cost thousands, the glasses or contacts you bought, the prescription medications you take every month. Even Medicare Part B and Part D premiums are deductible. Many people don't claim this deduction because they don't think their expenses are high enough. But if you had a tough medical year, add it all up. You might be surprised how much you can deduct. Keep all your medical receipts and statements. Now here's something really important. There are deductions you can take even if you use the standard deduction. These are called above-the-line deductions. According to TurboTax, they're called this because they appear above the line where you calculate your adjusted gross income. Above-the-line deductions lower your AGI directly, which is super valuable. Why? Because your AGI affects so many other things. It determines if you qualify for certain tax credits. It affects how much you can contribute to retirement accounts. It even impacts some financial aid calculations. So what are these magical above-the-line deductions? I'm going to cover the biggest ones next. These include retirement contributions, student loan interest, and educator expenses. If you only remember one thing from this video, remember these deductions. Here's one of the best above-the-line deductions: traditional IRA contributions. The IRS allows you to deduct contributions to a traditional IRA from your income. For 2024, you can contribute up to $7,000 or $8,000 if you're 50 or older. Here's what this means. Let's say you put $6,000 into your traditional IRA this year. That $6,000 comes right off your taxable income. If you're in the 22% tax bracket, that saves you $1,320 in taxes, and your money grows tax-free until retirement. There are income limits, though. If you have a retirement plan at work, your deduction may be limited based on your income. But even if you can't deduct the full amount, contributing to retirement is still smart. You're building your future wealth. If you have a 401k at work, you're already getting tax benefits. Traditional 401k contributions provide an above-the-line deduction, meaning the money comes out of your paycheck before taxes are calculated. Let's say you earn $60,000 and contribute $6,000 to your 401k. The government only sees $54,000 of income. You just reduced your tax bill without doing anything extra at tax time. The deduction happens automatically through your employer. For 2024, you can contribute up to $23,000 to a 401k. If you're 50 or older, you can add another $7,500. That's $30,500 total that can reduce your taxable income. If your employer offers a match, that's free money. Take it. Do you have a health savings account? Then you have another above-the-line deduction. HSA contributions are fully deductible and reduce your AGI. For 2024, individuals can contribute $4,150, and families can contribute $8,300. HSAs are actually triple tax advantaged. First, your contributions are deductible. Second, the money grows tax-free. Third, withdrawals for medical expenses are also tax-free. No other account gives you 3 tax benefits like this. To have an HSA, you need a high-deductible health plan. So if your insurance has a deductible of at least $1,600 for individuals or $3,200 for families, you probably qualify. Check with your employer or insurance company. This is one of the best tax savings tools available.
Do you have student loans? There's a deduction for you. You can deduct up to $2,500 of student loan interest as an above-the-line deduction. This applies even if you take the standard deduction. Here's how it works. Your student loan company sends you a Form 1098E showing how much interest you paid during the year. That amount, up to $2,500, reduces your taxable income. If you're in the 22% tax bracket, that's up to $550 back in your pocket. There are income limits. The deduction phases out at higher income levels. Single filers start losing the deduction around $85,000, but for most people with student loans, this deduction is available and valuable. Are you a teacher? Thank you for everything you do, and the tax code thanks you too. Teachers can deduct up to $300 for out-of-pocket classroom expenses. If you're married to another teacher, you can deduct $600 combined. What counts? The markers and colored pencils you bought for your art class, the books you purchased to stock your classroom library, the hand sanitizer and tissues you keep for sick students, the science equipment you bought for experiments. All deductible. This is an above-the-line deduction. That means you get it even if you take the standard deduction. Many teachers spend way more than $300 on their classrooms, so while the deduction isn't huge, it's better than nothing. Keep your receipts. Do you work for yourself? Then you pay self-employment tax. But here's the good news. You can deduct half of your self-employment tax as an above-the-line deduction. When you're employed by someone else, your employer pays half of your Social Security and Medicare taxes. When you're self-employed, you pay both halves. But the IRS lets you deduct the employer half. This can be thousands of dollars. Let's say you're a freelance designer who earns $80,000. Your self-employment tax is about $11,300. Half of that, $5,650, is deductible. That's a significant reduction in your taxable income. Don't forget this one. Here's another amazing deduction for self-employed people. You can deduct 100% of health insurance premiums for yourself, your spouse, and your dependents. This is an above-the-line deduction. Health insurance is expensive. If you're paying $800 a month for a family plan, that's $9,600 per year. All of that is deductible if you're self-employed. In the 24% tax bracket, that's $2,304 back in tax savings. This deduction is available if you have net profit from self-employment and you're not eligible for employer-sponsored insurance elsewhere. So if your spouse has insurance through their job that you could join, you might not qualify. Check the rules carefully. Okay, now let's put it all together. How do you actually decide between standard and itemized deductions? According to H&R Block, you should use whichever gives you the bigger deduction. Here's the process. First, look up your standard deduction based on filing status. Second, add up all your potential itemized deductions. Your state taxes paid up to the limit, your mortgage interest, your charitable donations, your medical expenses over the threshold. Third, compare the totals. Whichever number is bigger, that's what you use. Tax software does this automatically, but now you understand what's happening behind the scenes. Knowledge is power when it comes to taxes. Before we go further, let's clear up a huge confusion. A Tax Foundation poll found that 64% of people don't know the difference between tax credits and tax deductions. These are not the same thing. A deduction reduces your taxable income. A credit reduces your actual tax. According to the Tax Policy Center, credits are more valuable dollar for dollar. If you're in the 12% bracket, a $1,000 deduction saves you $120, but a $1,000 credit saves you the full $1,000. This is why the question, would you rather have a $1,000 credit or a $1,000 deduction, has a clear answer. The credit is better, always. Understanding this difference can help you make smarter financial decisions. Let me show you exactly how deductions translate to tax savings. According to Western and Southern, your actual savings depend on your tax bracket. The higher your bracket, the more valuable each deduction becomes. Imagine you have a $10,000 deduction. If you're in the 12% bracket, that deduction saves you $1,200. If you're in the 24% bracket, it saves you $2,400. If you're in the 32% bracket, it saves you $3,200. Same deduction, different savings. This is why wealthy people love deductions so much. They're in higher tax brackets, so every deduction saves them more money. But deductions help everyone who uses them. Even a 12% savings is real money. To understand deductions fully, you need to understand tax brackets. The U.S. has 7 federal tax brackets: 10%, 12%, 22%, 24%, 32%, 35%, and 37%.
But here's what most people get wrong. Over half of Americans don't understand how brackets work. They think if you're in the 22% bracket, all your income is taxed at 22%. Wrong. Only the income in that bracket is taxed at that rate. Let's say you're single and earn $50,000. The first $11,600 is taxed at 10%. The next amount up to $47,150 is taxed at 12%. Only the remaining $2,850 is taxed at 22%. This is called marginal taxation, and understanding it helps you understand deductions. Now, let's talk about deductions that people miss. According to TurboTax, 25% of people eligible for the Earned Income Tax Credit don't claim it. That's millions of people leaving money on the table. Other commonly missed deductions include the state sales tax deduction for people in states without income tax, charitable mileage at 14 cents per mile, out-of-pocket expenses when doing volunteer work, reinvested dividends that increase your cost basis. These add up. Over the next several slides, I'm going to show you specific deductions that most people overlook. Pay close attention. One of these might save you hundreds or even thousands of dollars. Do you live in a state with no income tax, like Texas, Florida, Nevada, Washington, or Wyoming? Then you can deduct your state sales tax instead. Most people don't know this option exists. You have a choice. You can deduct either your state income tax or your state sales tax, not both. The IRS provides tables to estimate your sales tax based on income. Plus, you can add sales tax from big purchases. So if you live in Texas and bought a $35,000 car this year, you can add the sales tax from that car to your deduction. In Texas, that's over $2,000 just from the car. This can make itemizing worthwhile even without a mortgage. Do you work from home? The home office deduction is one of the most commonly missed deductions. If you use part of your home exclusively for business, you can deduct those expenses. There are two ways to calculate this. The simple way is $5 per square foot up to 300 square feet. That's a maximum of $1,500. The regular way involves calculating the percentage of your home used for business and applying it to your expenses. This deduction is only for self-employed people and business owners. Employees who work from home cannot claim this deduction under current rules, but if you have a side business, even a small one, this could apply to you. Do you drive for business? The IRS standard mileage rate for 2024 is 67 cents per mile. This covers gas, maintenance, depreciation, and insurance. You just need to track your miles. Let's say you're a real estate agent who drives 15,000 miles per year showing houses to clients. At 67 cents per mile, that's a $10,050 deduction. That could save you over $2,000 in taxes. Keep a mileage log. There are apps that track this automatically using your phone's GPS. Every time you drive to meet a client, to a business meeting, or to pick up supplies, log it. This simple habit can save you thousands. Did you lose money in the stock market? There might be a silver lining. You can use capital losses to offset capital gains. And if your losses exceed your gains, you can deduct up to $3,000 against regular income. This is called tax loss harvesting. Let's say you sold one stock for a $5,000 gain and another for a $7,000 loss. Your net loss is $2,000. You can deduct that full $2,000 from your ordinary income and reduce your tax bill. What if your losses are more than $3,000 over your gains? You can carry forward the excess to future years, so a big loss one year can provide tax benefits for many years to come. When you drive to medical appointments, that's deductible too. If you itemize and your medical expenses exceed 7.5% of your income, you can include mileage to and from doctors, hospitals, pharmacies, and therapy. The medical mileage rate is lower than business mileage, about 21 cents per mile, but it adds up. If you drive 500 miles per year going to doctor appointments, physical therapy, and picking up prescriptions, that's $105 extra on your medical deduction. Don't forget parking fees and tolls for medical trips. The $10 parking garage fee at the hospital, the $5 toll on the highway to the specialist. Keep track of all of it. Every dollar counts toward exceeding that 7.5% threshold. Yes, you can deduct gambling losses, but only up to the amount of gambling winnings you report. You must itemize to claim this deduction, and you need records to prove your losses. Let's say you won $5,000 at the casino. You have to report that as income. But if you lost $4,000 at the same casino, you can deduct $4,000 against your winnings. Your net taxable gambling income is $1,000. Keep your slot club records, lottery tickets, even losing ones, sports betting slips, and bank statements showing casino withdrawals. Without proof, you can't claim the deduction. Did you make energy improvements to your home? You can claim a tax credit of up to 30% for solar panels, wind power, and other clean energy systems. Remember, this is a credit, not a deduction. It's more valuable. Smaller improvements qualify too. Credits of up to $500 for energy-efficient doors, insulation, and HVAC systems. If you replaced your old water heater with an energy-efficient model, you might get money back. These improvements save you money 3 ways. First, lower energy bills. Second, tax credits. Third, increased home value. It's a win-win-win situation. The Earned Income Tax Credit is one of the most valuable tax breaks for working families. It provides up to $7,830 for families with 3 or more children. And it's refundable, meaning you can get money back even if you owe no tax. But here's the problem. 25% of eligible taxpayers don't claim it. That's 1 in 4 people, leaving thousands of dollars on the table. The rules can be confusing, but the money is worth figuring out. You need earned income from a job or self-employment. There are income limits, and the credit amount varies based on your income and number of children. Use the IRS tool or tax software to check your eligibility. Do you have children under 17? The child tax credit can be worth up to $2,000 per child. This is a credit, so it reduces your tax bill directly, dollar for dollar. Part of this credit is refundable through the Additional Child Tax Credit. So even if you don't owe $2,000 in taxes, you can still get some money back. This helps lower-income families who need it most. The child must be under 17, a U.S. citizen, and live with you for more than half the year. You also need to claim them as a dependent and provide more than half their support. Income limits apply, but they're fairly high for most families. Do you pay for childcare so you can work? The Child and Dependent Care Credit can help. You can claim 20 to 35% of qualifying expenses depending on your income. For 2024, you can claim up to $3,000 in expenses for 1 dependent or $6,000 for 2 or more. That means credits of $600 to $1,050 for 1 child or $1,200 to $2,100 for 2 or more. If you use a dependent care FSA at work, you can still use this credit, but only for expenses over what you put in the FSA. So if you put $5,000 in your FSA but spent $6,000 on childcare, you can claim the credit on that extra $1,000. Are you or your child in college? 2 major credits can help. The American Opportunity Credit provides up to $2,500 per student for the first 4 years of college. The American Opportunity Credit covers 100% of the first $2,000 in qualifying expenses, plus 25% of the next $2,000. Part of this credit is refundable. Up to $1,000 can come back to you even if you owe no taxes. Already graduated? The Lifetime Learning Credit offers up to $2,000 per year with no limit on years. This covers continuing education, graduate school, and professional development courses. Here's something crucial that people forget. When you reinvest dividends, those reinvestments increase your cost basis. This means when you sell, you have less taxable gain. Let's say you bought $10,000 of a stock. Over 10 years, you reinvested $2,000 in dividends. Your cost basis is now $12,000, not $10,000. If you sell for $15,000, your gain is only $3,000, not $5,000. That's significant tax savings. Always track your cost basis. Brokerages usually do this automatically now, but for older investments or inherited assets, you might need to dig through records. This can save you thousands in taxes on investment sales. We talked about business mileage, but don't forget charitable mileage. When you drive for charity, you can deduct 14 cents per mile. It's lower than business mileage, but it still adds up. Driving to deliver meals for Meals on Wheels, taking supplies to the homeless shelter, transporting equipment for your church event, picking up donations for the food bank, all deductible at 14 cents per mile. Track your charitable miles separately from business miles. Write down the date, the charity, and the miles driven. At the end of the year, add it all up and include it with your charitable deductions. Here's a weird one. If you served on jury duty and had to give your jury pay to your employer, you can deduct that amount. This creates a wash, so you're not taxed on money you didn't keep. Some employers pay your full salary while you're on jury duty, but they require you to hand over the jury duty payment in return. You still have to report the jury pay as income, but then you deduct it. Keep your jury duty payment stub and any documentation from your employer about this arrangement. This is a small deduction, but every dollar counts. Are you in the National Guard or Military Reserve? You can deduct travel expenses for drills when they're at least 100 miles from home. This includes lodging and half your meal costs. This is an above-the-line deduction. You don't need to itemize. If you travel to a drill site 150 miles away, stay overnight, and pay for meals, those costs come right off your taxable income. Our military members sacrifice so much. If you're a reservist, make sure you're getting every tax benefit you've earned. Keep all your travel receipts from drill weekends. Moving expenses used to be deductible for everyone. Not anymore. But military members with permanent change of station orders can still deduct moving costs. Household goods moving costs, storage costs, travel to your new location, including lodging. These are above-the-line deductions, meaning you get them even with the standard deduction. Sadly, civilians can no longer deduct moving expenses for work relocation. This changed under the Tax Cuts and Jobs Act. But if you're active military, this valuable deduction is still available to you. This is crucial if you're divorced. Alimony is no longer deductible for divorces finalized after December 31st, 2018, and it's no longer taxable income for the recipient. If your divorce was finalized before 2019, the old rules still apply. The person paying can deduct alimony. The person receiving must report it as income. Check your divorce date. If you're currently negotiating a divorce, these rules affect how you should structure payments. Consult a tax professional and a family law attorney to understand the implications. Here's a pro tip. You can sometimes control when you take deductions. If you're close to itemizing this year, bunch expenses together. Make December charitable donations in December instead of January. Some people alternate years, itemizing one year, taking the standard deduction the next. They bunch all their charitable giving and other itemizable expenses into 1 year to exceed the standard deduction. Instead of giving $5,000 to charity each year, give $10,000 every other year. In the giving year, you itemize and get the deduction. In the off year, you take the standard deduction. You give the same amount, but potentially save more in taxes. When you make estimated tax payments to the state, those are deductible on your federal return. These count toward your SALT deduction. Don't forget to include them. Every quarter when you send that estimated payment check to the state, record it. At the end of the year, add them all up. Include this amount on your Schedule A with your other state taxes paid. Remember, the SALT deduction is capped at $10,000 for 2024, going up to $40,000 in 2025. But you should still track everything and claim what you can. Property taxes are part of the SALT deduction we discussed earlier. If you own your home, or even own land, your property taxes may be deductible when you itemize. Your county sends you a property tax statement each year. Or check your mortgage statement. Many mortgages include property tax in the monthly payment. Your lender will report the amount paid. Own a vacation home? Those property taxes count too. Just remember, All your state and local taxes combined are limited to the SALT cap. But every bit helps when you're trying to exceed the standard deduction. What proof do you need for deductions? The IRS requires documentation for everything you claim. Without proof, your deduction could be denied in an audit. Bank statements showing charitable donations, 1,098 forms for mortgage interest and student loan interest, receipts for medical expenses, mileage logs for business and charitable driving, records of all business expenses. Keep tax records for at least 3 years after filing, but if you have major deductions or a complex situation, keep them for 7 years. It's better to have proof you don't need than to need proof you don't have. Tax software makes finding deductions much easier. Programs like TurboTax, H&R Block, and others walk you through questions to identify deductions you might miss. The software asks questions like, "Did you make any charitable donations?" and "Did you pay mortgage interest?" Based on your answers, it calculates whether you should itemize or take the standard deduction. Free options exist for simple returns. Paid versions help with more complex situations like self-employment or investment income. The cost is usually worth it, especially if the software finds one deduction you would have missed. Sometimes you need a professional. If you're self-employed, have investment income, own rental property, or have a complex situation, a CPA or enrolled agent can find deductions you'd miss. Tax professionals typically charge $200 to $500 for individual returns, more for businesses. But if they find $1,000 in additional deductions, they've paid for themselves and put money in your pocket. Look for CPAs or EAs. Ask for referrals from friends or family. Check reviews online. A good tax professional is worth their weight in gold. Did you miss a deduction on a past return? You can fix it. You have 3 years from the original filing date to file an amended return. You file Form 1040-X to amend your return. Show what you originally filed, what it should be, and the difference. If you're owed money, the IRS will send you a refund. If the missed deduction would save you more than the cost and hassle of amending, do it. Free money is free money, even if it takes some paperwork to get it. The IRS estimates over $1 billion in refunds go unclaimed every year. That's money people earned but never claimed. About 1.1 million people don't file returns even when they're owed money. If you had income taxes withheld from paychecks but your income was low, you might be owed a refund. The only way to get it? File a return. You have 3 years to file and claim a refund. After that, the money goes to the government permanently. Don't let your money disappear. Research from Stanford and the IRS reveals that the tax gap, the difference between taxes owed and collected, exceeds $500 billion annually. This affects everyone. Much of this gap comes from honest mistakes and complexity. People don't understand the rules. They miss deductions they should claim. They overpay because they don't know better. The more you understand about taxes, the better you can navigate the system legally and ethically. You shouldn't pay more than you legally owe, and you shouldn't pay less either. Knowledge helps you get it right. Americans lose an estimated $246 billion per year due to lack of financial knowledge. That breaks down to nearly $1,000 per person. Tax illiteracy is a huge part of this problem. The Tax Foundation reports that over 61% of Americans don't understand basic tax concepts. By watching this video, you're already ahead. You're taking control of your financial future. Share this knowledge with family and friends. Teach your kids about taxes before they get their first job. Help your parents make sure they're getting the senior deductions they deserve. Financial literacy is a gift that keeps giving. If you're 65 or older, you get extra benefits. The standard deduction increases by $1,950 for single seniors or $1,550 for married seniors. If you're 65 and blind, you get both additional amounts. Seniors often have higher medical expenses. Remember, if your medical costs exceed 7.5% of your income, you can itemize them. Prescription drugs, hearing aids, glasses, dental work, long-term care, all potentially deductible. Social Security may or may not be taxable depending on your total income. Understanding how deductions affect your overall tax picture becomes even more important in retirement. If you run any business, Even a side hustle, you have deduction opportunities. Self-employed individuals can deduct ordinary and necessary business expenses directly from their income. Your computer and software, professional subscriptions and memberships, business insurance, office supplies, marketing costs, website hosting, professional development courses. The list goes on. Separate your business and personal expenses. Use a separate bank account and credit card for business. This makes tracking expenses and proving deductions much easier. The Qualified Business Income (QBI) deduction lets many self-employed people and small business owners deduct up to 20% of their business income. This is huge. Sole proprietors, partnerships, S corporations, and some rental income can qualify. There are income limits and rules about what types of businesses are eligible. But if you qualify, this deduction is incredibly valuable. The QBI deduction is complex. Income limits start phasing it out at $191,950 for single filers. If you have significant business income, work with a tax professional to maximize this deduction. When you buy expensive equipment for your business, you don't deduct the full cost immediately. You depreciate it over time. The IRS allows different methods for depreciating business assets. But here's a shortcut. Section 179 lets you deduct the full cost of qualifying equipment in the year you buy it. That new computer, that vehicle, that machinery, potentially deductible all at once. There's also bonus depreciation that allows immediate deduction of certain asset costs. The rules are complex, but the savings can be substantial for businesses making big purchases. If you use a vehicle for business, you have two options for deductions: the standard mileage method or the actual expense method. Choose whichever gives you the bigger deduction. With standard mileage, you track business miles and multiply by the IRS rate, 67 cents for 2024. If you drove 10,000 business miles, that's $6,700 in deductions. Simple. Alternatively, track all vehicle costs: gas, insurance, repairs, registration, depreciation. Then multiply by the percentage used for business. If you spent $8,000 total and used the car 60% for business, that's $4,800 in deductions. Good record keeping is essential for maximizing deductions. Use apps to track mileage. Scan or photograph receipts. Use accounting software to categorize expenses. Save everything digitally. Don't wait until April to organize. Make record keeping a habit throughout the year. Every time you buy something that might be deductible, record it immediately. Future you will thank present you. Organize expenses by category: medical, charitable, business, education. This makes preparing your return much faster and helps ensure you don't miss anything. The best time to think about deductions is before year end. Review your situation in November or December. Make strategic moves before January 1st. Maximize contributions to retirement accounts. Have you maxed out your 401k contributions? Have you contributed to an IRA? Are your itemizable expenses close to the standard deduction? Should you make additional charitable donations? Do you need to realize investment losses? Tax planning versus tax preparation. Tax preparation happens after the year ends. Tax planning happens throughout the year. Planning lets you optimize. Preparation just reports what already happened. Let's bring it all together. Here are your action steps. First, understand the difference between standard and itemized deductions. Second, identify all above-the-line deductions you qualify for. Third, calculate whether itemizing saves you more. Track your potential deductions. Keep records of charitable donations. Save medical expense receipts. Log business miles. Document professional expenses. Use tax software or a professional to ensure you're getting every deduction you deserve. Don't leave money on the table. The knowledge you've gained today puts you ahead of 90% of Americans. You made it. You now understand tax deductions better than most Americans. According to the Tax Foundation, most people don't understand these concepts. But you do now. Remember, tax deductions are not loopholes. They're built into the system. The government wants you to save for retirement, give to charity, own a home, and invest in education. Deductions are your reward for those activities. Share this video with someone who needs to hear it. Leave a comment if you learned something new.
and subscribe for more videos that put money back in your pocket. Your financial future is in your hands. Now go take control of it.